Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is the president and founder of Pento Portfolio Strategies. He is an active money manager. Michael Pento, welcome back, sir.
Good to be with you guys.
That's absolute pleasure. You said, Michael, in a recent interview, corporate insiders have sold more shares last year than ever before in the history of records. How big of a risk do you believe the stock market is in for 2022?
I think, not to be a Cassandra or use hyperbole, I think it could be probably the odds are very high for the biggest crash we've ever seen in stock market history. And that's just a setup that I see. First of all, you had the fiscal cliff that I've talked about immensely. I talked about it all last year and it's here. So you've gone from $6 trillion in helicopter money, almost all of it printed by the Federal Reserve, handed out to people. It's going from 6 trillion to zero.
Mm-hmm.
So you already have the economy slowing precipitously because of that fiscal cliff. Then into that, you have inflation at a 40-year high. You have interest rates that are spiking, not only here, but across the globe. And look at BTB spreads to German spreads. So Italian 10-year notes to German 10-year notes. It's skyrocketing by 10 basis points per diem. This is unheard of for an Italian 10-year that was below 1%,
Mm-hmm.
and a German 10-year it was negative. The rates are soaring all over the globe, and then on top of that, you had a massive inventory build in Q4, which has to be drawn down. Which, when you draw down inventory, it takes away from consumption, so it's a net negative to GDP growth. So what I'm saying is the fiscal cliff, inventory build, highest inflation in 40 years, spiking interest rates are all adding to a trenchant drop in GDP growth. So we're going to go from 5.5% GDP growth for all of 21 to Q1 on a seasonally adjusted annualized rate, zero, goose egg. Yeah. That's a pretty big drop. And then you have earnings growth, which is going to go from 45% in 2021 to low single digits. Now, on top of all that, gentlemen, you have a monetary cliff coming. And on a rate of change basis, that monetary cliff will be the biggest cliff we have ever seen.
Yeah.
So we're going from, to be specific, $120 billion a month of QE towards the end of 2021 to zero. No new money added to the base money supply into the Fed's balance sheet by the first week in March of this year. Then we'll also have in March our first rate hike. You'll have another one in May and another one in June. So you think about a Fed funds rate at 75 basis points from zero by June. And people will say, well, the Fed's funds rate used to be, 20. No, they don't understand calculus. They don't understand rate of change. It's the rate of change, not the actual level. It's how fast you're going from where you were from that base. So if inflation was at one time 15%, but now it's only 7%, people say, oh, it's still half where it was. No, inflation used to be almost 0, and now it's 7. It's the rate of change that matters. And on top of everything I just said, with that monetary cliff, with the ending of QE, and then going into rate hikes, the most pernicious part of this is the quantitative tightening. I believe Mr. Powell and the FOMC will start quantitative tightening sometime around June, and it'll be around $100 billion per month. So it's watch out for what happens later in Q2 is where I see the most salient portion of this decline and onwards.
So do you think they'll be able to pull this off without? Yeah, I mean, everyone on Twitter is speculating. All right, the Fed's trapped. The Fed's probably going to fail with what they're doing, right? At some point in the taper process to zero, or the rate hike process, or the running off of the balance sheet, watching the paint dry, so to speak, at some point, the market's going to absolutely freak out. Correct. Does that cause the Fed to then pivot back to easy money? Or do you think, we just got to suck it up and take the pain and go through with it?
So here's how I look at it. Yes, of course, the Fed's going to pivot. Of course, the Fed can't, prosecute and end its goal of, I think they're talking about, 2.5%, 3% on the Fed funds rate, or even higher in some cases, 7 rate hikes this year. Of course, everything's going to break on the way there. as an active money manager, it's my responsibility not to be there when it breaks. So I don't want to be net long ARC investments, stocks that have no earnings or very little revenue and just promises of the future. So when you go into a dramatic slowdown in earnings and GDP growth, one thing you cannot have is you cannot have all your investments in speculative stocks, high volatile stocks. So that's part of my model. I have a 5-point model spectrum between deflation and recession and stagflation and intractable inflation. So you have to know where to invest. One thing you can't do is have all your money in that, speculative bucket. Mm-hmm. If you're smart about this, you could say to yourself, listen, I want to pare back on my exposure to the market. I want to buy low volatility investments. I want to have some hedges in place. I want to have lots of cash. This way, when the market does crap out, and it will, then you have all your liquidity. You can actually be even making money while this happens. And it's really very predictable. I have a 20-point model. It'll let me know when high yield starts to break, when the credit markets start to freeze. This is what will bring the Fed back into the dovishness side of the ledger. I mean, I call him Powell the pivoter because that's exactly what he is. Remember, inflation is transitory. Oh, no, it's not. And then it is, he goes back and forth depending on the, QT is like watching paint dry. Oh, no, it isn't. Let's just start lowering interest rates. He was lowering interest rates 3 times before COVID broke out. We're going to have an inflation print on Thursday, which could be 7.5%. Yeah. And that's a 40-year high in inflation. You can't pivot because somebody in the private equity business says, "Hey, Jerome, we're losing some money." No, you have an obligation now, which comes from Joe Biden and the Democrats. You have an obligation to defend the purchasing power of the middle class. And by the way, speaking as a libertarian, he absolutely should do that. Now, of course, his primary mandate is to make sure banks are solvent and that the markets function freely. So when the credit markets freeze and when the stock market craps out 30% plus, then of course he will acquiesce. But I don't want any part of that in my portfolio.
So I've watched many of your interviews, and you've recently said that you've been adding gold and even gold miners to your portfolio. Is that part of your defensive strategy right now?
It is. When we reach a liquidity event, everything gets dumped except for treasuries and cash and US dollars. We're not there yet. Why I increase gold right now is because I believe we have reached a maximum bearishness as far as interest rates on the Fed funds rate can go. So the Fed funds futures market is pricing in 5 to 6 rate hikes. I don't think they get to 3 before the whole thing implodes. So I think Powell moves, like I said, in March, May, and June. And then the balance sheet is going to do the preponderance of the damage, which I think flattens the yield curve, causes another recession and a stock market crash.
Just to clarify this, so you think they're gonna finish the taper? They'll do at least a few rate hikes to save face because they've talked about it so much. But actually running off the balance sheet, you think they're going to get to that point too? I mean, a lot of people think it'll never get to actually running off the balance sheet.
Okay, so what? A lot of people think a lot of things, but I can tell you this: what would be the reason why Powell would not try to shrink a $9 trillion balance sheet, which was $800 billion in the end of 2007? What would cause him to not do that? Well, it would be when the markets no longer function. The credit markets freeze. You can't issue any junk bonds. The repo market, people are tapping that repo facility, that standing repo facility that the Fed has put in place. When the stock market drops 30% or more, that is when he'll say, oh, well, guess what? Forget about inflation being 7%. I have a problem here where banks are going to be insolvent. I am now going to have to say, forget about inflation, fighting inflation. I am now going to defend Wall Street. Okay. That doesn't happen, Jim, right away. That just can't. It could happen right away when inflation was 1.5%, trying desperately to get to 2 or higher, so inflation averages at 2%. But when inflation's 7 plus or 7.3 or 7.5, whatever that print is on Thursday, then you can't just acquiesce to the stock market at every little hiccup. Can't do it.
Yeah. Yeah. So he has to break, the market has to break first before he can ignore inflation. For now, he has to pay attention to inflation.
Can I just tell you this? By the way,
Yeah.
I called for a 30% crash in the stock market. It was very probable in the second quarter of 2022. We've already had a devastating, decline in stocks. The average stock in the Nasdaq was down like I forgot the number, like 40%.
Yeah. Apple's holding it all up, right? The index numbers.
I mean, the average, not the index, the average stock in the index was down like 40% a few days ago.
Yeah.
So we've already had a crash, and Powell hasn't blinked at all. He knows until the credit, he's most acutely aware of the money markets. What's the commercial paper market doing? What's the repo market doing? What's the junk bond market doing? That's what he's most focused on. Until those markets freeze, and by the way, all those things are part of my model. When those things start to seize up, then I know that the market's going to crash. Then I know Powell will acquiesce shortly thereafter. But until then, he's going to feign interest in fighting inflation.
Michael, does silver play at all into any of your thinking in any of these? I mean, are you playing the silver equities at all, or are you strictly a gold guy at this point?
I'm strictly gold at this point, and the reason is I want to own silver when I see global growth accelerating, and at the same time I see inflation accelerating. So you get that industrial and monetary component at the same time. I just don't see that happening. I think global growth is going to, look what's going on in China, going on across, even the ECB's now is talking about raising interest rates. So a lot of Bank of England is raising interest rates. You have a lot of central banks, main dominant players in the globe are tightening monetary policy. And here's the thing, I'll leave you with this. Well, this drives me crazy when I was listening to CNBC or Bloomberg this morning. Somebody was actually saying from a major bank how there's no excesses out there. No excesses. And I'm like, he says the economy's deleveraged and the consumer is so healthy. So I just want to say, I want to leave you with four statistics. Non-financial business debt as a percentage of GDP is at an all-time record high. So nominally speaking, and as a percentage of GDP, an all-time earth-shattering record high. Margin debt as a percentage of GDP, all-time record high. The total market cap of equities as a percentage of GDP, an incredibly all-time record high. It's close to 200%. At the peak of the dot-com bubble, it was 140%. And real estate prices as a percentage of income are at an all-time record high. And this buffoon sees no excesses out there. That is why I say the Fed is forced to fight inflation, 40-year high, above 7%, into the most unsustainable and unstable asset bubble the history has ever seen. Triumvirate of bubbles with the bonds, real estate. That is why I think this thing is going to blow. It's going to crash rather precipitously. And I don't want any part of that in my portfolio. I want to be out and short, net short in the portfolio when that happens. So when Powell acquiesces to trying to rebuild the whole asset bubble, structure of the economy back into place, I can go long with a much bigger pile of capital.
Last question for you. You had mentioned, the ECB starting to, for the first time in, I don't know how long, they're talking about raising rates. And there are numerous countries in the Eurozone and the Euro currency that really, they're only surviving based on the European Central Bank buying their bonds. I mean, no one in their right mind buys Italian debt at 1%, right? Yeah. Do you see a major euro crisis happening in some of these, I don't know, the weaker countries as the ECB raises rates or stops buying their debt?
The periphery of Europe, I mean, you look at an Italian 10-year note at 1.8%, which is lower than a US 10-year note. I mean, that should never be the case. I mean, those rates are rising precipitously. And I mean, even by the time this interview is published, the whole structure can change. That's why you can't go to sleep. You can't buy and hold a 60-40 portfolio because you're going to get destroyed on your bonds and on your equity portion of your portfolio. You are getting destroyed. Mm-hmm. But how high can an Italian 10-year note go before the whole thing unravels in Europe. And it can go very quickly because you're looking at insolvent nations. Greece is another. I mean, remember in 2012, the Greek 2-year note was, or it was a 10-year note, was at 40%.
Yeah, it's at 1 or 2% right now.
This is where the market wants to take it. And by the way, you and all your audience should know is that debt to GDP ratios are much higher in Greece and in Italy than they were in 2012.
Yeah.
So until Draghi said he's going to do whatever it takes, well, people said, okay, I'm going to front run the massive and unprecedented and unlimited bid for treasury, for bonds in Europe, for boons and bonds in Europe. And that brought the German 10-year boon, below zero. Still is. So without the heavy hand of Madame Lagarde now, where do you think the market, the free market, wants to take interest rates? How fast do they get there? And what condition does the continent look like? Well, so 2022 is going to be a year of watershed trenchant moves where you go from, inflation was transitory, then we're fighting inflation, the markets melt down, and then you have this, capitulation from central banks probably later towards the end of this year. That's what I'm looking at. That's the blueprint I'm following. But the most important point is that you have a model, you follow the actions, the rate of change in fiscal and monetary policies. You're far better off doing that than just buying and holding, tech stocks, Amazon. That kind of thinking, that kind of mentality will destroy your retirement.
Michael, thank you very much. I know you're tight on time. We appreciate you giving us, 20, 30 minutes of your time today to chat. The audience loves you. And we look forward to talking to you again in about 3 months.
I don't know if they can love me as much as Gerald. I don't know if they can love me as much as Gerald Clemente.
Clemente? Yeah, he's hilarious.
Yeah,
he's
but
hilarious.
I hope it's close.
Yeah.
Listen, my only motivation is to try to make people money as best I can in all economic situations.
Yeah. I'll put the link to your website in the description for the audience if they want to look you up. We appreciate your time, sir.
Thank you, Jim and Ivan. Take care.